Welcome to today's video where we delve deep into the hidden costs and potential pitfalls of tax shelters and how an obsession with tax minimization could be detrimental to your overall financial health and personal well-being. By understanding the complexities and drawbacks of aggressive tax strategies, you can make more informed decisions that align with your long-term financial goals and lifestyle preferences. Let's break down the critical insights and strategies for optimizing your tax responsibilities effectively. Hit that subscribe button and let's get into some money-saving, life-changing information. Key point 1. The true cost of tax shelters. A tax shelter is a legal strategy used to reduce taxable income and lower tax liabilities through various mechanisms like retirement accounts, real estate investments, and charitable donations. These strategies utilize the nuances of tax laws, such as deductions for IRA contributions or the tax-exempt status of municipal bond interest. However, it is crucial to use tax shelters appropriately to avoid legal issues, and consulting with financial advisors or tax professionals is recommended to ensure compliance with tax regulations. Tax shelters, often touted for their immediate tax savings, usually come with various hidden costs that could deplete your resources more than they can serve them. For example, consider the legal and accounting fees required to establish and maintain tax shelters. These costs can quickly accumulate, especially if the shelter involves complex structures or international elements. Another example, ongoing compliance and reporting requirements can be time-consuming and require hiring additional staff or consultants, further increasing operational expenses. Beyond monetary expenses, the opportunity cost, the potential gains that could have been realized had these resources been deployed elsewhere, is a critical factor often overlooked. For example, the money and time invested in maintaining a tax shelter could have been used to expand business operations or invest in market opportunities yielding higher returns. Key point 2. Diminished net worth and quality of life. Rigid adherence to tax minimization strategies can lead to choices that negatively impact your net worth and reduce your quality of life. Take, for example, individuals may end up residing in less desirable locations just to benefit from lower tax liabilities. This decision might affect their daily living experience and access to better employment or business opportunities. Also, consider the restrictions required to qualify for certain tax benefits, such as limited travel or mandatory time spent in specific jurisdictions can lead to missed family events, reduced personal freedom, and increased stress. The qualitative costs of tax shelters, such as reduced personal happiness, social isolation, and potential conflict with family, often go unaccounted for. For instance, a business owner might miss significant family milestones due to the travel restrictions imposed by their tax strategy, leading to strained relationships and personal regret. Key point 3. The illusion of savings. What initially appears as a smart financial move by utilizing tax shelters can turn into a financial nightmare when these structures are challenged or invalidated by tax authorities. Take, for example, if a tax shelter is deemed non-compliant, the individual may face retroactive taxes accompanied by penalties and interest, which can far exceed the original tax savings. Another example, consider the legal fees and the time required to address challenges from tax authorities or to dismantle non-compliant structures can be substantial, adding to the financial burden. Tax regulations are continually evolving, with authorities closing loopholes and introducing new compliance requirements. This dynamic landscape can render many tax strategies obsolete, forcing taxpayers to adjust strategies frequently and incur additional costs. For instance, a strategy that legally minimized taxes one year might become a compliance liability the next, resulting in unexpected financial and legal repercussions. Key point 4. Risk versus reward. The potential financial and reputational risks associated with aggressive tax shelters often outweigh the perceived benefits, making these strategies unattractive for sustainable wealth building. For an example, engaging in aggressive tax strategies can attract unwanted attention from tax authorities, leading to audits and investigations that can tarnish personal and professional reputations. Another example, the stress and uncertainty associated with relying on legal loopholes for tax savings can lead to anxiety and detract from focusing on more productive business activities. Wise financial planning involves assessing potential risks and ensuring that any adopted strategy provides a balanced approach to risk management. Overly aggressive tax strategies not only pose a high risk of adverse legal outcomes, but also divert attention from core business practices that are essential for long-term growth and stability. In today's video, we explored the often overlooked aspects of tax shelters and emphasized the importance of considering both the financial and personal implications of tax strategies. By choosing a balanced and informed approach to tax planning, you can ensure that your strategies enhance rather than hinder your financial and personal aspirations. If you found this video insightful, please like, subscribe, and share your thoughts or experiences with tax planning in the comments below. Your feedback helps us create content that addresses your specific interests and concerns. Stay tuned for more practical financial guidance in our upcoming videos.